The Nitrogen Fund is a low volatility equity hedge fund managed on a fundamental basis with a value bias. The fund consists of two books, a long-term fundamental book and a short-term trading book. The fund has 200 million rand of assets under management. For more, Rowan Williams from Nitrogen Fund Managers joins us in studio. Now, I know that you have explained the duality of the system before. I'm sorry to have to make you do it again, but just for those who weren't following our conversation a couple of months ago.
Sure. So as you said, it's a hedge fund, which means basically we can go long shares, but I guess unlike the long-only managers that you spoke to earlier, we can also go short. So that enables us to hedge and take advantage of, volatile markets and when markets go down. So that allows us to take advantage of two sides of market movements.
Well, it must be fun and games right now with the volatility out there.
That's why I'm mentioning the volatility. What's been interesting is that volatility has in fact picked up. I think you're seeing a lot of news flow come out, and some positive, negative economic news flow followed by positive interventionist type potential news flow, and that's really been driving markets both, I guess, up and down. And we see an increase in volatility as an increase in opportunity.
I was just going to say, you took the words right out of my mouth. Yes. So this is good times for you.
Yes, we're seeing, and it's been interesting. We've been in the markets for some time with the fund, and obviously 08, the end of 07, 08 was a very volatile time in the market, and we're actually seeing some of those kind of movements coming back just in the last month or so, which I think from a hedge fund perspective is exciting, yes.
Rowan, tell me, you split your book between the longer term holdings and the short term trading. What is that split? Is it 60-40 or is it more 80-20?
No, we set it at 60-40, but I guess it varies, and that's what we're talking about in terms of the market environment. It depends sort of what kind of market that we're in, and I guess having those two parts to our fund allows us to take advantage of different types of environments. So for the last 2 or so years, the market's been much more trending, I guess, in an upward trend, a bull type trend. And so there, the long-term fundamental type holds are going to show, bear fruit and drive the returns. But as you get into a more choppy up and down type environment, you're going to switch to focus more on the trading and the shorter term trading, trying to take advantage of those shorter term movements.
Just the comment you made earlier, we're going back to 07, 08 type volatility. I looked at the VIX index this morning, it's down at 16.7%. It's almost as though everyone has said, Mario Draghi and then the German finance minister all making the right types of noises. But, agreed, we'd heard this before in the past, and we can
and that's the understatement of the year. We've heard this in the past.
Well, it's interesting. I think the market's also getting used to it. So, and you can see just the mere sort of talk by Draghi and the potential for QE3 is already rallying the markets. There actually haven't been any formal announcements. It was merely the mention of it and sort of looks like what is going to be more easing, further monetary stimulus, and the markets take that as a positive and bullish sign. So I think you need to be aware of that, and I think the regulators and the central bankers have actually managed it fairly well, that just the utterances of Draghi can have such a positive impact. That shows you actually how well the feedback is going into the markets. It can be dangerous, and if you look at it, potentially is driving speculation as well.
But Draghi is almost following a path that Bernanke followed back in 07, 08. And the question is, Bernanke hasn't been that effective. He's kept the US out of recession per se, but
that's right.
He hasn't lifted economic growth because all the banks have done is sat with the cash and traded their book.
Yeah, I think our view is that Bernanke actually did the best he could, and it's hard to say, could he have done better, because we can't really tell, because imagine he didn't pour all that stimulus into the US economy. And I think, as you said, Draghi's taken a leaf from Bernanke's book and is looking to follow that. So it has a lot of unintended consequences, like the banks being able to sit on the cash and just make a lot of money, which obviously doesn't please a lot of people. So regulators think going forward need to be more cognizant of that, but they've embarked on this path of easing, and I think they have to, they're committed to it, and they will continue. And so you mentioned 08, and so there is a big difference, and I don't think we like the volatility. I don't think we're going to get that same level of volatility as in 08.
Well, never say never. Because
have you forgotten that I'm sitting on the other side of the desk?
Sorry.
Oh, thanks very much. Just wanted to remind you. Can I jump in here with a line of questioning? In terms of this additional liquidity, you say the markets are starting to move and to benefit from this liquidity. Which are the areas poised for the best surges upwards without any competitive information or giving away any competitive information from your trading side?
Okay, so and you've seen there's been a lot of momentum and in the local market as well. We had a rate cut last week, which further sort of has added to let's not say frenzy, but to the buying appetite. And so that still the interest rate sensitive stocks are doing really well. So that, and more so again, the consumption-based stocks, the retailers and some of the large industrial stocks, the likes of Imperial and Bidvest. So I think those stocks will continue to do well as long as the good times kind of roll. And
it doesn't look as though the good times are going to disappear anytime soon on the interest rate front in South Africa.
I think that's right, yeah. And you're seeing it's very supportive of stock prices. I think less supportive of sort of economic activity because they're quite low already. Doesn't mean people are going to go out and start splurging and spending, but it's a less of an impediment.
Well, it takes a lot of the pressure off. If you see, people with excessive loans, that reduction, that's the impact is 600 rand per million on the home mortgages.
Right,
and you just have to extend that to people who've extended themselves on motor vehicles, etc. And you're sitting, you're pretty much sitting in a fairly better position than you were 2 months ago.
No, that's right. So I think, and it's taken the pressure off because I think we were starting to see a slowdown in retail sales. You're seeing it in the latest sets of results, really more on the sort of volume side in terms of unit sales growth. The sort of top line growth has been reasonable, but some pressure, some slowing. And that will take the pressure off. So that we're still looking at that sector, and I guess you've got to sort of be quite dynamic and sort of be open because the prices look very full, but you've got to say where are there still opportunities, and then we tend to look, say, for stocks that have lagged the general sector and look to pick those up.
Talking about potential opportunities, which side of the fence are you sitting when it comes to Anglo-American?
Yeah, so we still don't like resources. Interesting, even this morning there was some comments by some very well-regarded asset managers saying they're starting to show value. I think. And if you look again, the interesting thing from a hedge fund, we often look at relative value, so the pair trades. And if you look at, say, Billiton compared to Anglo's, it's far outperformed it massively. And then you look at the management team and you say, you feel, the Billiton's getting the rating because of the management team as a superior management team. Absolutely. So it obviously is showing more value than it ever has, but does that mean it's good value? We're not what's certain yet, because again, and you're seeing a lot of it, a lot is riding now on potential stimulus, if not this week, at least by September. And if that doesn't come through or is still disappointing relative to expectations, you could see a further pullback, and that would still impact resource stocks, including something like Anglo. We don't trade it that much, so we're a bit agnostic to it, but it wouldn't be a favoured stock of mine.
Also, what about the favourite stock in the South African universe, that being Sasol? Just interested on your view. Is that deemed resource, stay away, industrial? How do you play it?
Yeah, I think it's actually, I'd say it's a composite of both. You've got the oil, which is resource, and then a big chemical element as well, which is industrial. So you've got both those elements to it. Again, I don't think it's the best run large resource company, and even though it's sort of a must-have for a number of asset managers, we still don't like it. Again, our basic premise is the outlook for the global economy is still poor, notwithstanding the amount of stimulus. And I think, given the amount of stimulus, it actually is very disappointing what the global economy is doing. So if you look at that, and it's starting to get stretched, balance sheets are starting to get stretched. How low can interest rates go? It's not that positive for the global economy, and hence the commodity stocks.
Rowan, thanks so much for sharing your insights. Rowan Williams, Director at Nitrogen Fund Manager.